Hi guys, good evening. So further to our discussion which we had on Saturday, we had bucketed all our ratios into four categories, and now we will pick up one category and discuss two ratios for that, right? This is a liquidity ratio, right? It is also called as short-term solvency ratio, right? Which means the company's ability to meet its short-term obligations, short-term requirement of payments, right? Uh, in the recent past, we have seen a lot of banks getting bankrupt and being sold, and one of the reason was that they had some long-term assets but did not had liquidity to meet the short-term obligations, right? Some of the businesses are into long-term revenue generation cycle, and in that they do have visibility that money will come after 6 months, 12 months, 1 year, 2 year, but they also have to meet their short term liabilities also. So it is very important that this ratio is also maintained, because even for a company with a healthier balance sheet may have this problem, right? So let us discuss couple of ratios in the liquidity ratio. So first is your current ratio, very, very important ratio. Normally, you can accept a ratio of 2 is to 1 for current ratio. What is the formula? Take all the current assets of a company in the balance sheet divided by all the current liabilities, and whatever number it comes, right? It is the current ratio. So 2 is to 1. If this number comes above 2, if you divide this, it's a good ratio, right? And what and all is included in current ratio? You have all current liabilities like inventory, debtors, cash and bank, receivables, and other current investments, etc. But don't include the prepaid expense item in that, because they are not liquidated, right? You cannot get money out of it. So exclude that. Current liabilities include all short-term creditors, short-term loans, bank overdraft, cash credit, because these are all the items which you might need to pay in very short period of time. Let's say 1 month or 15 days to 3 months time, and hence these are all current liabilities. Even as per, if you go as per the strict definition, whatever is receivable in next 1 year is current asset, and whatever is payable in next 1 year is current liabilities, right? So go by that definition and try to figure out current liability, current ratio for any of the financial statement you pick up, right? Second ratio is quick ratio. It is more conservative than a short term ratio, right? In that, even you don't include inventories in your quick ratio definition. And generally acceptable ratio is 1 is to 1, right? Current liability definition remains the same as we had discussed in the previous example. Quick assets, you will exclude inventory, right? Prepaid expense, we have anyways excluded. So these are the two ratios we will discuss. We will also take up some examples, live examples, and try and calculate these ratios in the upcoming sessions. Hope you like this video. Thank you very much. Have a nice day. Bye.